Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hello and welcome to another episode of the ASB Investment Podcast, the show where we unpack the financial questions and topics that Kiwis are asking right now. And today, we're diving into the recently released 2025 New Zealand Retirement Expenditure Guidelines. I'm your host, Nigel Grant, and joining me is someone that fans of this area of the industry or have been following research and the debate around retirement and KiwiSaver will know well. It's Professor Claire Matthews from Massey University, one of the leading experts in retirement planning, financial education. Welcome, Claire. How are you?
Kia ora, Nigel. Nice to be with you. And yeah, everything's good.
And just to remind, or I guess to give listeners some background, you're based, you were saying as we were getting to know each other before, you're based at the Palmerston North campus?
I'm based at the Palmerston North campus. I do visit the Albany campus reasonably often these days. But yeah, primarily in Palmerston North.
All right, because I did the drive from Wellington to Hawke's Bay for the first time in my life the other day, and all the wind turbines, and I got to see Massey, that campus of Massey for the first time, and it was lovely. It was nice to be able to do a drive you hadn't done, before, so it was good to see Massey in all its glory. Let's start with the basics. I guess, in your opinion, what are the expenditure guidelines and why are they important for Kiwis planning their retirement?
So the guidelines were developed because what we wanted to do was to provide some information to people in terms of what does spending in retirement look like? Because the reality is for people that are planning for retirement, they don't know what it's going to look like. And so what we wanted to do was to provide some information that they can use in their planning. So we take data from the Household Economic Survey that Statistics New Zealand provide for us, and we break it down by type of household, 1 and 2 person households. By region, we use metro and provincial. And then we have 2 choices of budget so that people can look at what is suitable for them, because there's no absolute right answer. And we're not saying people should be adhering to one of these guidelines, but it's just here's some information to help you, to help inform your own budgeting for retirement. And
because and just before we get into a question on the specifics behind the labels, like so has your research or was that the originator of the no frills and choices terms? Is that right?
Well, there was a group of us working on putting the guidelines together, and we knew we wanted to have the 2 sets of guidelines, and we wanted something that was more basic, and we wanted something that also was at the higher level of spending. And we did consider some different terminology. We did think about beer and champagne at one stage, but we decided we needed to step away from the alcoholic connections. Yeah. And so that's where we settled on the no frills and choices.
And this is just, before we get into the specifics of them, I wanted to ask you, whenever I think your research and these releases come out, I often get a message or have a conversation with mum and dad, and it's kind of like, oh gosh, are we, the latest numbers have come out, what does that mean for us? Do you get any other, I guess, feedback around that, and maybe how powerful your research is on kind of, influencing?
Absolutely. There is a huge amount of feedback that comes out every time the report comes out. I'm actually interested how many retired people are interested in the guidelines, because it's not, the reality is the guidelines are not for them.
Right.
We're not trying to say you're doing well or you're not doing well based on this. It's about the people that are still coming up to retirement, but retired people do find it really fascinating, and I do get a reasonable amount of feedback just from the general public. It's fascinating.
Yeah, and I guess we've been around the country. That drive I was talking about, we were out seeing clients and stuff, and I think a lot of these particular clients were in done pretty well in their life, and we're still I think we're unsure. Like, do I have enough to spend? It's almost this Kiwi psyche. Of unsure, maybe I can't, or can I retire or not?
I think it's just such an uncertain time, because it's going to be so different when you retire. And speaking as someone who's getting closer, it's just this uncertainty, because you're going to go into a situation where you're no longer, for most people, you're no longer earning a regular income. And so you haven't got that money coming in. You've got New Zealand Super, but the reality is that's at a fairly low level. So you haven't got this money coming in regularly, and you've got this pot of money that you can use but it's the uncertainty about how long is that going to last? How much can you spend? So there's just so much unknown, and it's so different to what you've had in your life up till now. It's understandable that there's uncertainty.
Yeah, John Smith, who I used to work with, who retired recently, he always called it you replace the paycheck that came from an employer to you pay your own paycheck. You're paying yourself. What I guess to just understand a little bit more, what is the difference between the no frills or beer and the choices champagne one? What I guess, are there any clear differences between the two?
Fundamentally, the no frills is a more basic lifestyle. It is still spending above the New Zealand super level,
right?
But you're going to be fairly restricted. The reason we went with choices for the other one is that in reality, you do have choices. You could think about, do I want to do A or do I want to do B? In terms of even purchasing groceries, do I want to buy steak or do I want to buy sausages? Whereas on the no frills, it might be, I was going to say buy mince, but all I hear recently is that mince is no longer the cheap staple that it used to be.
Spam maybe. Yeah.
But with the no frills, you're going to be buying whatever is cheapest.
Yeah.
So you, or maybe a little bit above that, but not much. You're not really going to have a lot of choice, and so that's fundamentally the difference. Is that one is a more basic, one is a more has more luxuries in it.
Yeah, and I guess especially if I can imagine if your life has been one of the two, potentially either way, making a transition to the other is going to be hard. Are there any key findings from the 2025 report that stood out? Any notable changes in spending or what people are or noteworthy shifts?
So in reality, it comes back down to the methodology that we use.
Yes.
So every 3 years we get new data from the Household Economic Survey from Stats New Zealand, and that's when you get the substantial changes. In between times, we're just adjusting for inflation. And so we're assuming that people are still buying the same things, and it's just the price is going to change based on whatever the inflationary impact has been over the last 12 months. So from 2025 to 2024, all we're looking at is the inflationary change. There were still some changes because it's really interesting to note that the inflation that our households face is different to the CPI. So a number of the households, most of the households, 5 out of the 8, faced inflation above the CPI.
Wow.
And it reflects the fact that the CPI is an average basket of purchases for the whole population. And the reality is retirees do spend different other types of parts of the household, other parts of the population. So they face higher inflation. So what that report tells us is that when our retirees complain about the impact of inflation, they are actually feeling it differently to the rest of the population. But there are some key drivers, food, property rates, because that's a big one for retirees because a lot of them do own their own house. And one of the key findings is that inflation for rates is huge. Energy, which is another big one for our retired households, and inflation again has been above average, but also recreation costs, because let's face it, in retirement you've got more time for recreation, so that's a bigger form of expenditure.
Yeah, I think talking about rates bills is the topic du jour for retirees potentially. I know
Absolutely.
From some that I hang around with. God bless them. They love that topic. So is there anything, I guess, to put you on the spot, is there anything within that basket for the retiree that is really different from the general NZ basket? Is it that recreation thing that's vastly different, or is there another thing that stands out?
No, so property rates, energy are other things that are quite substantially different. Food is a little bit higher. So it just reflects the fact that, their lifestyle is going to be a little bit different because they're not working, and so they are spending their money in a different way.
Yeah.
And property is a big part of what they're doing. So sure. There are some definite differenents.
Yeah, and I'm going to be I'm a gardener now. I'm sure I'm going to be still gardening when I'm retired, hopefully. So I'm sure those, the cost of that, that potting mix isn't going down. What does it mean? What does it mean for retirees who are relying primarily on super, would you say? Okay,
so the issue for people that are relying primarily on super is that New Zealand super is really good. It keeps our retirees out of poverty, which is huge. However, it does provide a basic level of lifestyle. So we look at, for the no frills group, which is still a relatively basic lifestyle, they are all still spending in excess of New Zealand super, and that's the second quintile. So there are people that do just live on New Zealand super. And one of the other things you asked about the feedback I get, one of the letters I almost always get is from somebody saying, I only get New Zealand super and I live fine. And yes, you can, but you're going to have even fewer choices, and it is going to be more simple lifestyle. And if that's what you want, that's absolutely fine. But also New Zealand super is essentially a fixed income.
Yes.
So if you're relying on that, the advantage is you know exactly what you're going to get, but you've got no ability to increase it. You get what the government gives you, that's it. So you've got to budget with that. And so if you're facing increasing costs, you've got no room to move, essentially.
Yeah, sorry, just a very quick question. How often is super re-baselined or reset?
It's reset annually.
Right.
So there is an annual adjustment, and it takes into account inflation for the previous 12 months and also how it compares to average wages.
Right, yes. I guess but again, if you're dependent on that, it can significantly alter or affect your lifestyle, I'm sure. You were talking about housing as a big part of retirement costs. Did the report say anything about the home generally that was consistent, or is there any other observations that are changing around I know the rates bill and the insurance bill, they're all they've been under a bit of pressure, but anything else that stood out?
So what stands out and what I get a lot of comment about is the fact that housing costs within the guidelines are actually quite low. And that reflects the fact that the data that we're using are for people that are currently retired. People that are currently retired are primarily from the baby boomer generation.
Yes.
There's still a few of the earlier silent generation still around, but the youngest is still in the baby boomer because we've got another 4 years of baby boomers to go.
Right.
And there's a very high level of home ownership. And so even though we talk about the housing costs, most of them have paid off their home loans, so you've got no home debt. Rates, yes, they've got to pay rates, and while that's increasing above the rate of inflation, it's still, in dollar terms, a relatively small amount, but it is, a fixed amount, and it is an absolute commitment. And then there's maintenance, which you've got some choices about. And if you go into retirement having done all your maintenance so you don't have to do it in retirement, then that's an advantage. So you've got people who don't necessarily need to spend a lot at the moment. It's going to change for the coming generations because we know there is a lower level of home ownership. And so there are going to be more that are retiring with in rental accommodation. But the other thing is there will be more retiring that still have debt, that they haven't paid off their home loan.
Yeah.
And so there is a change that's coming.
Oh, so in the study will start to need to incorporate potentially a rent aspect and a debt servicing aspect as well.
It will incorporate it as the people that retire reflect that situation.
Yeah, but not
But that
yet.
is going to take a long time for that to actually really flow through. We are starting to see it has changed a little bit, but it hasn't changed a huge amount at this stage.
Yeah, I guess was that like a sort of in the next 20 years type thing, I would assume.
Yeah, 10, 15 years, that's when you'll start to see the difference.
Yeah, sort of, it's quite a sobering thought. You sort of go, will I still, even if it's just the tail end of something, will I have some debt servicing costs from 65 to 70, even if manageable? Yeah. Christina Brown on the podcast talks every quarter about investor confidence, and that we run an investor confidence survey, every 3 months. And we've been seeing a bit of a decline in investors. It's a broad swathe of New Zealand, their kind of view of their own home as the best way to grow wealth. Amongst that portion of New Zealand that you're looking at consistently, is there anything that you think structurally behind that? Is the home still as important as ever?
I think there's two parts to that question.
Yeah.
So I think partly why you're probably seeing that in the investor confidence survey, my perception would be that it's because house values have fallen, or at least not been rising.
Yep.
And so people are just recognising that, hey, they don't always rise. And so from that perspective, that's reflected in an understanding that perhaps it's not the best way to grow their wealth. The other thing is, if it is your own home, and there's a saying, you can't eat your house.
Yeah.
So having a house that is worth a huge amount is not terribly valuable if you don't have the income coming through to assist in actually providing you with income to spend. So it can make you feel a lot wealthier, but it's not necessarily useful from a perspective of actually living. And so hopefully this view was also reflective of improved financial literacy amongst their population and a recognition that house values have some value in terms of increasing, but it's not actually really impacting on your wealth unless you're going to realise that capital gain in some way.
And I guess it's a really interesting point you raised, because if you were in the fortunate position enough to really stretch and buy a big, a really expensive home for you in some area, but it really impacted on your ability to, your life around that, and maybe you would assume that it would, well, of course it'll go up 10% next year. That might have been quite a sea change for your overall mindset.
Yeah. We know from various research that people feel wealthier as their house and as their wealth increases, even if if it's only on paper.
Yeah.
And when it falls, they feel less wealthy. And so I think that's just what's coming through.
Yeah, I just sort of, wonder, I was talking to Christina Brown a little bit, you sort of think that property investment was the number one area to go with, but maybe the days are now where it's actually, well, maybe you might have to buy something and do it up and add value instead of just, sitting on it as such. For those, I guess, as a flow-on effect, for those considering renting or moving into a retirement village, are there any key financial implications they should be aware of, whether that's part of the research or just in terms of your, looking at the stuff over a long period?
Yeah. So in terms of renting, so there's kind of two different situations. So if you're thinking that you're going to be in retirement and renting, then you actually have to plan for that. There's no reason why you shouldn't be fine in retirement with renting, providing you have planned for that.
Yes.
And what it means is you've got to think about how much is it going to cost me for rent on a weekly basis? And therefore, how much do I need to save as a lump sum to cover that rental cost? Now, Shannon Beale.
Yeah, Shannon Beale. Yeah, from Simplicity.
Yeah.
Yes.
Yeah. He's made the point that whether you are renting or in your own home, you should be no better off or worse off economically. Which is true to an extent, but it reflects the fact that if you are renting, you need to be saving what you're not putting into the house. So renting should theoretically be cheaper than owning your own home.
Yes.
Might surprise people, but theoretically. And what you should be doing is saving that extra and putting it aside, and then that will cover your rentals and retirement. So as long as you plan for renting in retirement, you're no worse off. But you do actually have to plan. If you go into retirement with the same level of savings as somebody who owns their own home, yes, you are going to struggle, and it is going to be more difficult.
Yeah, and I guess that point ladders perfectly back to sometimes people who are not natural savers stretching to buy a home, and that forced saving mechanism by the mortgage is, out of sight, out of mind. I don't want to know about it, but it forces me to save because I won't save elsewhere, right?
Yeah, absolutely. So it can be useful. So then moving into the retirement village living, you shouldn't really go into retirement village living thinking that that's going to be financially advantageous, because in reality, depending on exactly what your situation is, when you sell your home, you're probably going to have to put a large portion of that home into buying the license to occupy the unit at the retirement village.
Yeah.
And then there are ongoing fees. So you don't just buy that and that's it. You've got weekly fees to pay, which are not low. So there are, it covers a lot of things that you would otherwise have been paying, but you're still going to be covering a lot of those costs, and you're still going to have power, etc. So it's not so much about saving money, it's about the lifestyle that you get. So you might have some advantages in terms of capital, but fundamentally, again, it's a matter of thinking about it and thinking, okay, if I do this, and what is it going to cost me, and can I actually afford it? And assuming I can afford it, then is the lifestyle that I will get from the retirement village. I have to say, having had an opportunity to have a look at a retirement village, it looks like a pretty good lifestyle.
Yeah.
There's lots of activities going on. You don't have to worry about mowing the lawn. Somebody's going to do that for you. So, there's some real lifestyle advantages. if you are interested in those and that's going to be good for you, then that's why you go into a retirement village. Don't go into a retirement village thinking, oh, this is going to be a cheaper way to.
Yeah, or go in there assuming it's an pure financial return investment. Yeah.
Oh, and no, it's absolutely not a financial. Your return is not good. Whatever you buy the unit for, you will get less back when you move out.
Yeah, but it's a quality of life thing, I guess. Yeah. So with a clear gap between NZ Super and, I guess for some, you're not saying it's everyone with that other group, but there is a gap between super and actual expenditure. Is there any guidance the report offers for kind of helping to bridge that gap, whether that's at retirement or, as you're saying, the guidance is, about those who are needing to get prepared for it?
Yeah. So there are different things that you could do. One is what the report does specifically say is, okay, to fund the difference between the different levels of expenditure in New Zealand Super, on a weekly basis, this is how much you need. What is the lump sum that you need to have to pay for that? And we use this calculators at sorted.org
Yes.
to do that. And I need to make the point that assumes that the lump sum is invested in a balanced fund.
Yep.
So you can have better returns if you go into a growth fund. And it also assumes that you are consuming the capital. I knew there was a second thing. It consumes the capital as well.
Yeah.
So at the end, so it's for age 65 to 90. We assume that you're going to live till 90.
Yep.
Then at 90, you're going to have no money left and you will be just living on New Zealand Super. Now,
Sure.
to be perfectly frank, at age 90, you probably don't care.
Yeah.
Most people, we know anecdotally, and there is some research to this effect, that people tend to spend less as they get older. So at 90 and onwards, New Zealand Super is possibly not going to be such an issue.
Yeah, at 65 to 75, maybe you're living your best life, and then after that,
Absolutely.
maybe yeah. Sorry, you were saying.
It does. Potentially then. So we do provide that. But there's also some suggestions as to there are options. So instead of investing in a balanced fund, hopefully, particularly if you start younger, you're going to be investing in a growth fund so you'll get better returns so you don't need to save as much per week.
Yes.
You can choose to delay your retirement. Hopefully, not everybody can do that, but you might be able to choose to delay your retirement, in which case you don't need to fund for as long and you've got longer to save. You might just want to continue working even though you've officially retired from your main job. Maybe you've picked up something part-time or sort of a side hustle that you're doing just to bring a little bit of pocket money, but also to give you something to do.
Yes.
Because some people in retirement do struggle and they do continue working, not for the money, but because they want to work and they want to be active and they want that interaction with people.
Yeah, healthy mind equals healthy body as well a lot of the time.
Yeah.
Do you find that people get overwhelmed with the quote unquote, like you need $1 million, those headline figures, versus focusing on, well, here's what you should be trying to save every month? Is it easier to break it down with the latter rather than fixating on the former?
Yeah, and people do tend to fixate on the former.
Yeah.
And there does tend to be a focus on the $1 million. And yet if you look at the guidelines, that's one household group. It's a two-person choices metro that needs $1 million. And that's two people. So they actually need $500,000 each. Yes. Which even that sounds a lot easier.
Yeah.
And so it is about breaking it down. And it's also about thinking about your budget and saying, well, maybe you won't spend, you'll go for a choices lifestyle, but maybe not quite to the full extent. So let's bring it back a little bit and spend a little bit less here and there. And so we don't need quite those lump sums. So it is about thinking about what do you want to spend and what sort of lifestyle do you want.
Yeah, and I guess it's trying to coach people that this lifestyle that you're looking at what's needed. That doesn't mean you're never going out. For instance, it might be in sort of in the midpoint, but it also means you're not going out and having a 5-course degustation meal 3 times a week because you don't do that now, and there's no expectation that you're ever going to be doing that. So why fixate on that? Is there any other before we wrap up? Is there any other advice for listeners who may be overwhelmed by these decisions and targets that you think is important?
I think that the key message is the best time to start saving was yesterday. The next best time to start is today.
Right.
So if you're not already saving, please start and plan and actually think about it. KiwiSaver is a great way of getting there. But don't just sit and forget. You do need to be thinking about it and you need to be reviewing it. And getting financial advice is really, really helpful. But it's It's don't. Another phrase I've talked about is don't sleepwalk into retirement. You
Right.
can't just kind of let it happen. You've actually got to be proactive about it. You've actually got to be thinking about what you're doing, thinking about what sort of KiwiSaver you've got, whether it's conservative, balanced, or growth. What your level of contribution is. Can you afford a higher level of contribution? Maybe you can't at the moment, but if you get a pay rise in 2 years' time, instead of taking all that pay rise, maybe increase your contributions to KiwiSaver, and so that KiwiSaver gets some of it and you get some of it. That can make a huge difference over time. And it's just looking at those little things.
You raised some really interesting, themes in what you were saying there around stuff that we regularly discuss on the show. One thing I wanted to just check on is often for customers who are saving for retirement, they maybe focus on the risk side too much of the immediate. My balance could move up and down, and I'm really uncomfortable with that. But actually, from what you were saying there, I kept sort of thinking what is the bigger risk not having enough at that moment where you want to stop working? Is that do you think that's fair? And are we too fixated maybe on the short term versus the long term?
Oh, absolutely. I think, and we don't actually understand risk. We always think of risk as being something negative, and actually risk isn't negative. Risk is just about uncertainty.
Yeah.
And so the share market goes down, but it also goes up.
Yes.
And over the longer term, it goes up far more than it goes down. And so you do need to think about the long term. And we do the same thing with insurance. It's just a lack of understanding of risk. And I think there is a lot of room for us to improve there.
Yeah, and I often think when I hear risk, with risk comes opportunity
Yes,
as well. It's part
absolutely.
and parcel. So, and finally, you were talking a little bit about contribution rates and checking that alongside fund types. One thing that's hit the news in recent time has been, the government, or more specifically, a part of the government being National's proposal to raise KiwiSaver contribution rates to 6. That might be both for the employee and employer. There's been a lot of, I guess, positive and negative views raised on it, whether that might be from small business side, because that obviously, how do you do that? Obviously positive from I guess from what we do here at ASB, a funds management point of view, but you sort of myriad different views. I guess when that came out, knowing we were going to be catching up with you, I really wanted to get your thoughts on it. I guess, what are your thoughts on it? And are they positive, negative, or is it, direction, I guess, for individual savers, or maybe even New Zealand as a whole?
So I'm a bit on the fence.
Okay.
I think it's
no,
just
that's great. That's a cool. I'm looking forward to hearing why.
So if you look purely at contribution rates, I think it's positive to see those being increased. But doing that without doing anything else is where I have the problem. And if you simply increase rates, you're going to have more people choosing to opt out rather than become a member when they start a new job if they aren't already a member. You're going to have more people taking contribution holidays, or contribution suspension, get the terminology right, contribution suspension. And it doesn't matter what the rate is. It can be 100%. But if you're on suspension and you're not actually contributing, it doesn't matter what the rate is.
Yeah.
So from that perspective, but there's also a whole lot of other things. So Te Ara Ahunga Ora, the Retirement Commission, recently came out with their triennial review of retirement policies. And there's a whole lot of recommendations in there around retirement income, including some things around KiwiSaver. Contribution rates is a part of that. And I think, yes, absolutely, let's increase the contribution rates, but as part of a bigger package looking at retirement income. And there are things that the Retirement Commission has recommended in terms of increasing government contributions for low-wage earners, total remuneration packages, and getting rid of those, because that's a major issue. It's wishful thinking, but what I would really like to see is a multi-party approach to retirement income. Let's stop using KiwiSaver and retirement income as a political football. Let's get agreement. And I know that is just so wishful. I can't see it happening anytime soon, but that's what we really need for it to become effective.
Yeah, and I whether you get through the research or not, but when we're talking to clients as well, sometimes you get the odd bit of feedback where it's, I'm not sure on KiwiSaver, because I'm never are the settings always changing, and even though it's probably the best thing to help you get to where you need to go, but it's a real thing. Some people are just, the lay of the land keeps changing. What we're saying is the lay of the land needs to change, to help people, I guess.
Yeah, and again, that's somewhere where I'm on the fence. I'd like to see KiwiSaver change because I think there are some major improvements that could be done. But on the other hand, it's like every time it gets tweaked, it
sets back.
It sets back because people are confused. And the reality is there are still people remembering, and there was an article just recently about it because it's a 50-year anniversary. There's still a memory of when Rob Muldoon in 1975 got rid of the previous KiwiSaver-like policy that the Labor government had introduced, which was not a good decision. But there's this concern that some people still express about that they're concerned that the government is going to take their money that's in KiwiSaver. I don't think they will. I'm confident that they won't because it's not their money. They haven't got access to it. The providers are holding it and it's in your name. You own that money. It's just that the government has put some rules around how and when you can access it. The government can't take that money. But because of what happened 50 years ago and because people have got long memories and their grandparents or parents experienced it and have told them, because it comes down through the generations, it has that still sets us back. And every time the government of the day fiddles with KiwiSaver, even whether it's positive or negative and whether it has a major impact or a minor impact, it just reminds people in the past the government has done this, and this is just a sign that they might do it again in the future.
Yeah, a quite valid triggering moment, I guess, isn't it?
Yes.
Yeah. Well, thank you, Claire, for your insights. I love this conversation. I mean, as I said at the start, I've heard you on the radio before, so it's been great to get sort of a private one-on-one conversation and understand a little bit more behind the research. For more information, you can check out the full report at massey.ac.nz, and useful planning tools, as Claire mentioned, are at sorted.org.nz. Us at ASB also have our excellent KiwiSaver tools that use a lot of the retirement expenditure guidelines that we've talked about today to help you plan. So they're very useful. They flow through to what little old ASB does as well. Check them out via internet banking. When I say that, Fastnet Classic for ASB, our mobile app, or on our website. But to wrap up to our regular final question, Claire, what's something you've been reading, listening to, or watching that you could recommend to our listeners?
So one of the things I've actually listened to recently was, I do read The Economist.
Yeah.
And they recently had a podcast about scams. And I was actually really fascinated because it was a deep dive investigation into the scam industry, the international scam industry, and it's eye-opening. It's just incredible, and it's something that I would really, really recommend. It may not have personal value, but it's just fascinating in terms of understanding the scams and also understanding, because they talk to some people and highlight some cases about people that have been caught by scams, such as in the US, so they have some really small banks there, but it was a chief executive of a small bank who ended up losing the bank's money, and the bank had to be closed after a long period of time because he got scammed. And so it's just really fascinating, and it might make people feel a little bit better if they have been a victim of a scam to understand that there's some real there's an industry behind it. There's it's not just random. There's some real hard work goes into making sure that they scam people. Yeah,
because it's not just maybe what the Herald might have on its front page where it's retiree has been coaxed or into a scam. It's happening across the board, all the generations, and to your point, like even CEOs are getting bought into it. So, and that's perfect. I think that's really. I think it really fits in with what a lot of the particularly important with retirees and protecting that nest they might have built up as well. Because it's probably a pretty lucrative thing out there. My I don't know if it really qualifies under I've been watching in my household the Christmas festivities take shape with my beloved wife and the regular trips to Spotlight and all the arts and crafts coming into the household. So I was, if you can, it's not financial advice, but if there's shares in Spotlight, I should be taking some out because and get some of my money back. But it's a shout out to Christmas and a shout out to arts and crafts. decorating the house at the moment. So if that's your household, I feel for you. But it's wonderful to see Christmas, that time of year coming to light. Claire, thank you so much for joining us today. I hope you had a good time.
Yeah, it's been great. I really enjoyed the chat.
And it's been wonderful to have you here. So I really appreciate the insights, and I'm sure for a lot of our listeners, this will help them understand, particularly what those labels, no frills, choices all mean and stuff. So until next time, everyone out there, happy investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.